Today we have Gary Richardson with us, and it's a real pleasure to have him, given the vast contribution that he has done to economic and financial history. Gary is professor of economics at the University of California in Irvine and research associate of the National Bureau of Economic Research. Among his large and very important contributions include history from the Federal Reserve, and where he was where he was staying and had great access. And if you haven't looked at it as part of the centenary of the Fed, then you should. Gary, as usual, is looking at this very interesting topic, in this case, the consequences of payment crisis. And he has been kind enough to prepare a large presentation, and is likely or willing to go, according to where the questions are coming from, to be more or less technical, according to what people will prefer. And that's over to me. So if you want to start making questions through the presentation, through the chat, I can field those. And Gary will have 25 minutes to talk, and that's me. Thank you very much, Gary.
All right, thanks enough for Bernardo, Miguel, and for everyone for coming here today. First thing I need to do is thank my co-authors, Chen, Chris, and Padma, who put a lot into this paper. And I have to, Padma works at the Federal Reserve Bank of Kansas City, so I have to give you the standard disclaimer that this is not the Federal Reserve's fault. And Chris was at the Federal Reserve Bank of Dallas when we wrote this, but he just switched over to the IMF. So there should be a disclaimer from the IMF, but I forgot to put it on the slides. The issue we're looking at in general is the impact of payments crises on the macro economy. And first to say, so I put a lot of slides together today, and the presentation, it's about economic history, but in the paper there's also a lot of technical details, because in the estimation we're doing something a little bit novel. So I'll go ahead and describe that, and then if people are interested in lots of the estimation details, ask me some questions and I can do more. But if we're less interested in the technical aspects, I can go on and describe kind of the results and the history and give the intuition about where the results are coming from. But the big question we're asking is, what is the impact of suspensions of payments, right, on the macroeconomy? And we want to get at this general idea is that the impact worth the routine and episodic costs that societies bear to prevent payment suspensions. The routine costs are costs of running regulatory agencies and imposing regulations on financial institutions, and then distorting the behavior of financial institutions from the behavior they would have in terms of investing if we didn't have these regulations. And then there's episodic costs that are associated with suspensions of payments, right? There's interventions that the government has to help banks, and then there's bailouts of the financial system. Now, a suspension of payments, remember, is defined when financial institutions stop making payments on their liabilities. We're going to be looking at really commercial banks. So this is a point in time when commercial banks stop paying their deposits to the depositors. And so the household and firms, some of their assets which were very liquid, suddenly become completely illiquid. Why do we want to answer these questions? Well, we'd say first that beliefs about suspensions of payments shape policy. In the US and in most other countries, policymakers and economists in general and the public believe suspensions of payments are bad things, and they occurred in the past and they were very disruptive. In the United States, where I am today, right, we had a series of suspensions of payments in the 19th century, late 19th century and early 20th century. And the last big suspensions of payments or series of these shocks was in the Great Depression. And after 1933, the United States decided we don't want to have suspensions of payments anymore. And created a lot of regulations, and we have Deposit Insurance Corporation, and we incentivize the central bank to prevent suspensions of payments from occurring. And there's a debate about how expensive and how costly these regulations are. So first thing is beliefs about suspensions of payments that are shaping policy. We believe these events are bad. We don't let them occur anymore. Second thing is, most payments are still made through commercial banks. In the past and today, most payments by value, about 95% of payments in the US begin and end in someone's commercial bank account. Now there's little modern evidence concerning the impact of suspensions of payments, certainly in the modern developed economies, because we just don't let these suspensions occur anymore. We decided back in the Great Depression that we don't want the payment system, particularly the part of the payment system operated by commercial banks, to shut down. And so we have, by regulations and just discretionary actions, we prevented these suspensions from occurring. And since policy doesn't allow this event to occur, we have little ability to know what the cost would be if we let the payment system shut down. Okay, so the method that I'm going to use to get at this issue is I'm going to examine 4 suspensions of payments that occurred in US states. 3 of these are going to occur in the 1980s, and the last is in 1991. So we're going to look at these state suspensions, and I'll explain why US states in a little bit, why they shut down their payment systems. But in each case, it was due to some problems with a state level deposit insurance system. And then to calculate our estimates of these effects, estimates of the effect of these shocks, we're going to introduce a novel method of Bayesian synthetic control. So we have a unified framework for estimation and inference. And this is the method gives you a lot of information about the sources and variation of persistence. And then it's really well tailored to fit our question and our data structure, which is like a very sparse data structure. We have 4 events in 50 states over a long period of time. So there's not many observations to look at. Then the data set we're going to use is state level macroeconomic aggregates for the United States from 1970 until the present. And then we're going to do a lot of robustness checks with county level data. But the paper focuses on state level first, because we're interested in this aggregate question, what happens to the macroeconomy as a whole? And second, because there's a lot more state level data sets available over this time span, particularly in the 1980s. You have many more state level data sets than you do county level data sets over that time. Okay. Our findings are that a prolonged large suspension of payments during a recession is going to have a substantial and persistent impact. A short or a small suspension of payments during an expansion has no measurable effect. So basically we say, if your economy is expanding, a small disruption of the payment system probably is not going to have an effect on economic activity that's large enough to get picked up in your macroeconomic aggregates. But if you're in a recession and near the trough of a recession and you have a really big shutdown of the payment system, that's going to have a really big and possibly permanent effect on your economy. So we measure the average treatment effects for an increase of unemployment of about a percentage point over 5 years. And then for labor force participation, we see a decline of about 1.8 percentage points over 5 years. So these are pretty large effects. Another thing we can do with our methodology is quantify the uncertainty about these potential risks. So the well, we give you the average treatment effects, and they're sizable. We say there's a small probability that these events can have really large impacts. So there's a 5% probability that per capita income could decline relative to controls by about 7% 5 years out, and aggregate GNP could have even a much larger decline. but with a very small probability. Okay. And so there's a lot of literature on suspensions of payments. Obviously, there's a huge historical literature, and then there's a big modern literature on this. Most of the modern literature uses models and calibration to estimate the impact of these kind of shocks, because there's not modern data on what happens in modern developed economies when you shut down the payment system, because we generally don't let that happen. There's also a really large literature on the costs and benefits of financial regulation. This literature basically says it's really difficult to understand what the costs or benefits are of financial regulation. The cost estimates vary very widely, and the benefits estimates vary widely too. So we're going to try to give you an estimate of the benefit of a certain type of financial regulation and a certain type of discretionary policy, which is very visible and potentially very expensive. But we want to say, is there some benefit, right, to preventing the these suspensions? And then we're contributing to the literature on synthetic control, and in particular, we're doing inference in a way that's different than's typically been done in synthetic control. And when I come to some technical details, I'll give you 1 or 2 minutes to explain what we're doing, what's different. I'll explain what synthetic control is, and then I'll say what we're doing that's different, and particularly why I think what we're doing that's different is really interesting to people doing economic history. So we sort of tailored this method in a way that's probably really useful in a lot of historical applications. Now, I want to tell you about the 4 shocks that we're going to look at. In these 4 shocks, they're in 4 US states. The deposits are going to be frozen. So deposits of all the commercial banks that are under the jurisdiction of the state's governor are going to be frozen by an unanticipated gubernatorial edict, and then they're all going to be later repaid. So the deposits, right, they're there. Suddenly, people still have them, right, kind of legally as an asset, but they can't access the funds. And then later on, they're going to get access to the funds again. So all the deposits and all these events are going to be repaid. There's uncertainty about the repayment a little bit, right? But it's basically these people have assets that they think are very liquid. Then the assets get frozen. There's some uncertainty about when they get the assets back. And then eventually all the assets come back. In all 4 of these events, credit's going to remain generally available to all of these individuals. So people have credit cards, people have access to mortgages and other forms of credit. So we're not looking at a shock to credit. We're looking at a shock to the liquid portion of individuals' portfolios. And in all these events, there's a very brief disruption of the rest of the payments architecture. But the payments architecture is gonna, and when I say payments architecture, I mean like credit card machines and ATM machines, other banks in the state. The payments infrastructure is gonna resume full operation very, very rapidly. And in the US, this is due to the efforts of the regulators, particularly the Federal Reserve. And I'll just give you an example. In Rhode Island, when the bank system shuts down, about 1/3 of the individuals in the state, they're going to have their deposit accounts frozen, right? In the US, remember, we have a system where you have 2 types of banks. Some are nationally chartered and nationally supervised, and some are state chartered and state supervised. So the governor can only shut down the state chartered banks, but the nationally chartered banks are still in operation. But in Rhode Island, about 1/3 of the people have their deposit accounts frozen. This includes large numbers of residents who are expecting to get payments from the federal government. So payments like Social Security checks or welfare checks and pension payments. And the technicians in the Federal Reserve Bank of Boston, they must have been very good COBOL programmers. So the payment system shuts down on a Friday, and over the weekend and on Monday, they reprogram the system to redirect all federal payments, and then the next day, all payments from the state government that are going to individuals' deposit accounts to from their frozen account to any other account they have in the state that's not frozen. And if the individuals don't have an account in the state that's not frozen, then they automatically open account for them at a Federal Reserve member bank, and they generate a letter. So this is 1991, so email is not as common then. So they generate a letter and they mail it out by first class mail, telling people where their new deposit account is and where they can get the funds that they've been anticipating. So, so the disruptions to the payment architecture, it's very minor. And like the Fed is also rushing in to make sure all the cash machines are gonna keep working. And so there is a very aggressive federal response. It's similar across all these states. The Fed is using, actually in some of these cases, the same technicians who worked in Ohio and in Nebraska and Maryland. They're gonna roll over and do their same, roll out the same assistance program in Rhode Island. So now let me tell you a little bit about the 4 states we're gonna look at and why we're having these shocks. So you guys remember, in the United States, we have deposit insurance that was created by the federal government in 1933. And this system is called the Federal Deposit Insurance Corporation. When we created the FDIC, we also, the same legislation gave the Federal Reserve the authority to set maximum interest rates that could be paid on deposit accounts. And that and so the Federal Reserve imposes maximums, and the highest rate that's allowed is 6%. So when the Federal Reserve imposes these interest rate limits, the interest rate limits are binding on all banks that have federal deposit insurance. And so in the 1970s in the US and many other places around the world, the rate of inflation rises, and it rises so it's higher than the deposit limit. This gives state governments an incentive to create a state deposit insurance corporation. So state chartered banks can get deposit insurance from the state chartered corporation, and then they're not going to be subject to the federal deposit interest rate limit. And on this map here, you see all the states in gray create a state chartered deposit insurance corporation to allow state chartered commercial banks and other financial institutions to offer interest to depositors in excess of this federal limit. And so a bunch of states create these programs, and then in those states, you see a lot of banks switch from national charters to state charters, and basically all the state charter banks are going to use the state insurance system and not the federal deposit insurance system. Now, 4 of these state level deposit insurance systems are going to fail, and there's this sort of a common underlying causes of this. And there's a good papers by Charlie Kalmuris and Bill English about the kind of common causes of the failure of these state deposit insurance systems. And it's basically they're charging pretty low premium, they have lax regulation, then there's mismanagement both of the state deposit insurance system and of a large insured institution. And so the deposit insurance system is gonna be in trouble because you have a large insured institution that's mismanaging its assets. And this is usually coming out of the 1970s and 80s, where these institutions had mainly been home lenders, and then they continue to be home lenders, but they start to invest in more exotic and they think potentially higher returning instruments. And sometimes they get large negative returns on these investments. So in each state, one large institution is revealed to have made really bad decisions about its investments and then be in financial difficulties. And there's a fear among depositors and among the state officers that the failure of this institution will drain all of the reserve funds from the state deposit insurance system. And then it could, the state would have to kick up money to cover any additional losses by other banks. All of this comes out in the newspapers, and the response of most depositors is, I didn't even understand that we had a state level deposit insurance system and it was different than the FDIC. so the depositors panic and they run the state chartered institutions, and they pull their money out of the state chartered institutions and either hold the cash at home, or they put the cash into a federally insured institution. So you get runs on the healthy institutions that are insured by the state, and the governors then step in to stop the runs. So they issue an edict that prohibits withdrawals at all of these state insured institutions. Now, the size of these shocks varies a lot across the four events. And here's a graph, and it tells you some of the basic features of these four shocks. So in the Rhode Island shock in 1991, it occurs during a recession, and it's very close to the trough of a big nationwide recession. The magnitude is going to be large and the length is going to be long, and I'll explain what I mean by large and long in the next couple slides. In Maryland, the shock, the magnitude is also very large and a little bit larger than in Rhode Island, but the length of that shutdown is very, very short, right? Like a week, a little more than a week. In Ohio and Nebraska, these suspensions are occurring when the aggregate economy and the state economies are expanding, and the magnitude of the contraction or of by magnitude, I can tell you what fraction of deposits in the state are going to be frozen. The magnitudes are pretty small, and the length of these are pretty short. And when we do our estimates, we're going to find that there's really significant effects of the payments crisis in Rhode Island in 1991, and the consequences of that shock are going to be really clear, and they're going to be obvious in all macro time series. But in the other shocks, there's no noticeable effect, right? And it's pretty clear on aggregate, the shocks in Maryland, Ohio, and Nebraska, they don't have a bad impact on the macro economy. Okay. Now, what do I mean by large? By large, I mean like the Great Depression in the US. So here's a table, and I compare the share of all the bank deposits that are trapped in a suspended bank for more than a week in the US during the Great Depression. I've done a lot of research on that, and I have a lot of micro data on the Great Depression in the United States. So I added up the share of deposits that are trapped in all, and this is in the Great Depression, all suspended banks in the Great Depression. This is from 1929 through summer of 1929 through to the summer of 1933. And yeah, we know the Great Depression is a period in time where you have lots and lots of suspensions. And about 12% of all deposits in the US are trapped in a bank for more than a week. And then we look at Rhode Island, and I do the same calculation, and we see the magnitude, right? It's comparable. So 12% of deposits in the US are trapped in banks for more than a week in the Great Depression, and 18.1% are trapped in Rhode Island. The length of time for which the deposits are trapped in Rhode Island is also, it's a lot longer than were trapped in the US during the Great Depression. So you can think of this shock to Rhode Island, which is, it's a small state, but it's a very large shock in terms of the fraction of deposits which are frozen and the length of time for which those deposits are frozen. And the magnitude is, yeah, it's comparable to what happened in the US nationwide during the Great Depression. So for a large payments crisis, you can think Rhode Island's shock in 1991 is comparable to the shock the US suffered, 29 through to 33. And then for this table points out Rhode Island shock is going to be very different than the shocks experienced by the other states. Now, the right-hand column here is going to recalculate the data I just told you about, the deposits that are frozen, and I give you deposits per household as a percent of median household income. So this is the median deposit frozen per household in the state. And you can see Maryland, the first line, so the MD is the abbreviation for Maryland. So the deposits trapped in Maryland relative to median household income are larger than in Rhode Island, 19.1%. So Maryland has a really large shock. Rhode Island, it's about 14% of the deposits tracked per household is about 14% of median household income. And in Ohio and Nebraska, it's smaller. So the shock was really big in Maryland and Rhode Island. And when we're saying big, we're saying this is the size of the Great Depression. The length of time the deposits are tracked, though, are very different in the two states. In Maryland, the depositors are going to get access to most of their deposits within a week. And so Maryland, they quickly assess the situation, and by the end of the first week, they allow all depositors to access their household accounts to some extent. So everyone is allowed to withdraw $450 per week. I know it doesn't sound like much, but that's, there's been some inflation since the 1980s. So that's like a couple $1,000 or $1,500 a week in today's terms. But the households, in addition to that discretionary withdrawal, they're allowed to make all scheduled credit payments. So they're allowed to pay their home mortgage, their credit card bills, their car loan payments. So all previously scheduled payments by the households, they're allowed to make using checks from their deposit accounts. And in addition, they're allowed to withdraw $450 per week for other expenses. So they can't withdraw all their funds, but they have access quickly to sufficient funds to maintain their kind of previous level of activity. And that's going to be different Rhode Island than Rhode Island. In Rhode Island, if your account is frozen, your account is frozen and frozen for often a very long time. So I want to explain that in Rhode Island, the resolution of this crisis is going to be largely for political and a little bit for legal reasons. So the crisis is going to coincide with a change in administration from Republican to Democratic. And it just similar to what happened in the US in 1933, when we switched from a Republican to a Democratic administration. And then the first act of the new Democratic administration in Rhode Island, just like Roosevelt's first act in 1933, was to shut down the banking system. So there was a crisis brewing, and the governor, the Republican administration in Rhode Island can't handle it. And actually they're tarred by association with it, because the bank whose malfeasance is driven the news coverage, which created the big run, that bank was a heavy contributor to Republican politicians. And there were Republican politicians on its board, and there turns out were a lot of Republican politicians and their cronies running the state deposit insurance corporation. So those Republicans lose power, and these new Democratic administration comes in, and they're happy to just blame all these problems on the Republicans. Now, after the Democrats shut down, the new Democratic governor shuts down the state banking system, they seek a federal bailout and pursue legal remedies to recoup some of the funds it looks like the state's going to have to pay out. So the state asks the federal government to bail out its banks, and then they ask it to help with households. And they request about $400 million from the federal government. There's a series of hearings, and this looks like the Democratic politicians in the state think their best hope of getting these federal assistance is going to be to let the crisis go and to keep people's funds trapped in banks. So when they go to these hearings, they can say, look, we have all these old grandmas and pensioners and very well-deserving people whose funds were trapped in banks by this bad actions of the previous administration, and you should help us out. And the federal government basically refuses. They give a little bit, and then the other thing
we have about 5 minutes more, Gary. Sorry.
Okay, so I gotta go quick. Okay. Okay. So so Rhode Island. Let's see. It's very long. Let me come quick to the estimates. So I'm going to tell you, we're going to do this estimation methodology. We're going to do something called the synthetic control. So synthetic control is where you look at a set of states that, or you have a set of observations, and there's an event that's going to do something to them. And you don't know what the correct control group is. And the way you decide what the correct control group is you look at the pre-treatment data, and then you say what set of the potential control units in the pre-treatment period looks like the unit that's going to be treated. And you just create a weighted average. The synthetic control is a weighted average of, our case, all of the US states that best approximates Rhode Island up to the point of treatment, or for the other states that best approximates the other states up to the point of treatment. And so it's a kind of simple idea. You decide what you don't know which is the best control observation, right? So you create a weighted average of all the potential controls and choose the weight so that the synthetic control in the pre-treatment period basically is as close to identical as you can to the treated unit. And then your estimate of the treatment effect is the difference between what happens with the real unit, like Rhode Island, and this weighted average of all the other states. So for each of these, so that's a kind of a good way, or kind of intuitive way to estimate the impact of a rare event, where you don't have a lot of data, you don't know what the right control unit is, and so you're going to make a comparison of the treated unit to the untreated units. So we use this methodology, and then in our treatment effect, we're doing something novel to allow us to conduct inference. And if you guys want to ask about that, I can tell you. And let me give you, this is a basic graph of the result. And here you can show, this shows us the impact of suspensions on unemployment in Rhode Island. And so the treatment date on the graph is December 1990. And then if you look at the horizontal axis, you have the time, every month is marked. And we're looking at the percent of the population that's unemployed. So we create a synthetic control. So here the blue line is the synthetic control. So that's the average of the other states, and the red line is Rhode Island. So you create an average of the other states that approximates Rhode Island in the pre-treatment period. And then you say what's the difference after the treatment, after Rhode Island shuts down the banking system between treatment and control. And then our method creates a probability distribution around the treatment control, because you're uncertain about what the appropriate control is, and we characterize that uncertainty. And then when we say that our estimate is, it's a very high probability that the treatment is having an effect in Rhode Island, it's because the red line here is far outside, right, the probability band. So it's very certain that after treatment, there's a deviation between the treated unit and the control unit. Okay. So, and then from that basic graph you saw, we can create an estimate of the average treatment effect, which you see here, which has a distribution around it. And then we can do this for each state. So this is the unemployment that treated versus control in the different states. And you can see we start this at the point of treatment. And for Rhode Island, the unemployment rate goes up, and it stays up, right? For here, we're going out 10 years. In the other states, the unemployment rate, it never moves in a statistically significant way relative to controls. And now we do this for lots of macro series. And from the estimate, what we're doing, kind of the most interesting thing. So this is just an example. This is another macro series. And then we do it for lots more macro series. So we have some graphs to explain the intuition of what we're doing with one macro series, and then tables that tell you kind of the kind of key statistics you can pull out of these series. The key statistics are like the average treatment effect, and then the probability the average treatment effect was, different from zero in a bad way. So the probability that unemployment rose, or the probability that labor force participation fell. And we calculate this for lots of macro series. And then the real question is, this is kind of this table. So you do this for lots of macro series, and then you say, when you look at all these series together, is there some common underlying shock to them, right? So does it look like all the series are being adversely affected, right? Unemployment is rising, GNP is falling, income is falling. Or do the shocks that you estimate at the treatment date, are they either very small and not statistically significant, or are they just going in different directions? And then you can estimate from these macro shocks the probability, or in the upper and lower bound, that there's a common shock affecting all of these series. And what you see on this table is we say that the probability that there's some common shock after the suspension of payments in the Nebraska, Ohio, and Maryland, it's zero. It's just really, really, really close to zero. But for Rhode Island, the probability of there being some common underlying shock, right, using all the data sets that you have, it's really these numbers, 47, 75% are really very high. So that's why we say, in this case, it looks like there's a big common shock, right, to the macroeconomic aggregates in Rhode Island, that they're all the macroeconomic aggregates are being adversely affected by this shock. So we look here at unemployment, labor force participation, income, employment, gross state product, right? All the data series that we have. Okay, so to wrap up, what do we conclude from this? In the paper, we have an exercise where we say, kind of, why should you care, right? This happened in Rhode Island, and it happened, 30 years ago, and the other states, these things happened 40 years ago. Can we learn something from this? And so in the exercise, we say we take the probability distributions that we've estimated for Rhode Island, and we apply them to sort of an analogous modern time point. We can do the same thing with the Great Depression, and we say, what happens if say after the collapse of Lehman Brothers in the US in 2008, if the US government had let commercial banks suspend payments for the kind of same time as Rhode Island. And then in terms of the US, right, in 2008, a shock to household balance sheets, the same size as the Rhode Island shock, would have been letting one commercial bank in the US suspend payments for 6 months, basically. So, well, I say one of the largest 4 banks in the US suspend payments for 6 months. So basically not bail out the commercial banks in the US and after Lehman Brothers, and say maybe one of those 4 banks would have had to suspend payments. And then you can estimate the aggregate effect of this shock. And when we do that, we see it's, potentially pretty large. And you can compare that, the cost of that shock, to how much we paid to not have the shock, which is the cost of all the bailouts and the running the regulatory agencies. And they're kind of about the same. So we say, from this exercise and from looking at how badly Rhode Island was affected by this historical shock, we think that the costs our government is spending to prevent these shocks from occurring, right, are probably reasonable. Okay.
Thank you very much, Gary. That was super interesting. And while the questions are coming through the chat, I'll probably make a clarification or ask for a clarification and maybe have a question. So if I understood the part of the story here is that except for Rhode Island, the intervention of the Fed was basically the correct one. They've done their job. Yes?
Yeah, I would say in all 4 of these states, what the Federal Reserve and the other regulators do is the same thing. So the federal regulators come in and they try to, as quickly as possible, shift all of the state chartered banks to federal programs. So they get them federal insurance, or they redo their charters. They give the same help to all these states, using the very same employees.
Yeah, I was thinking more around comparison with free banking, where there is no Fed and no regulators, and then these would have been a much bigger effect. Adverse effect.
Yeah. So it's possible, particularly the Maryland shock, which is very large. So if this was in a, say, if this was in the US before 1910, when a lot of states didn't have state regulatory agencies, yeah, some of these shocks you think could have lasted longer, particularly Maryland, which has got like a 30 or 35% of the residents of the state have money that's trapped in banks, and the money that's being trapped is a really big share of their annual income. But in the end, all these deposits are paid, right? There's just a disruption because there's uncertainty for a while about which banks have money to make the payments and which don't, and it takes a while for the bad banks to liquidate their assets. So prior to the creation of all this regulatory apparatus, and without these interventions, there's some reasons to think the shocks would last longer. But if you remember back to, say, the days of the US in the 1840s and 50s, or even in the 1930s, because these suspensions happened regularly, there were banks and financial institutions that themselves would provide services to people in these interims. So instead of waiting for the state to do this, right, we used to have other banks and financiers who would come in and would help out. So one thing that would happen in the past is very quickly, other banks and all these local clearinghouses would offer people to buy their deposits in the trapped banks at some discount. So households that had money trapped could always get some access to the money by selling their trapped deposits to somebody else. And that was a very common feature of these past crises, which would, so there was a market response when we didn't have regulatory responses, which would limit some of the impact. And we don't see those market responses in these 4 instances.
Yep, thanks. We still haven't had anybody raising their hand or making a question through the chat. So I will go on with a second question. Here's Mark Billings. Mark, if you want to unmute and make your question.
Hi. Hi, Bernardo. Hi, Gary. How are you doing?
Hey, Mark. How are you?
I'm well, thanks. Yeah. So, given all that's gone on in US banking in the last 30 years or so, and I'm thinking of the deregulation and consolidation and so on that's taken place, and the 2008 financial crises and all the regulatory tinkering, etc., that's followed on from that. How is it possible to envisage similar situations to the ones that you're looking at arising now?
Yeah, I mean, this crisis is a political decision about discretionary policy. Maybe the current U.S. administration is a little bit more competent, but this could happen in the U.S., right? So how would this happen? Think back to 2008, right? In 2008, Lehman Brothers shuts down, and then later that week, Ben Bernanke, Hank Paulson, they go to the Oval Office and they say, we need the backing of the president and the Congress. We need $700 billion. This is on Friday of the Lehman week. They say, we need $700 billion authorized today because we got to make $700 billion in promises to the big US banks and to a bunch of banks around the world, or next week they're going to be run. Right? And this meeting is very well documented in their publications and in kind of a lot of media that was at the time. And actually, I was the Fed's official historian, so I've read a lot about this. And so they're asking George Bush, and they have the majority and minority leaders of the House and the Senate there, and they have the president and a bunch of his staff, and they say, we need you guys in the next few hours to authorize, get some votes through Congress to authorize $700 billion so we can provide confidence to the US banking system. and we have to buy AIG, make all the payments through AIG. Of course, that was illegal, right? The Fed, AIG sued, and it was shown that what the Fed did was illegal in violation of the law for its mandate. And the Fed knew that when they did that transaction, but they said, we got to do it, right? Why did they have to do it? They said, if we don't do it now, there's a big chance that one or more of those institutions is not going to be able to make its payments next week. They're going to be run, right? And so now when push came to shove in 2008, right, the Federal Reserve and the federal government took these extraordinary actions, which actually were in violation of federal law, but they said, we got to do it because we can't have any risk that any of these big commercial banks would suspend payments. Because they said the cost of even a short suspension of payments could be very, very high. So could the decision on that day have been very different? I think so, right? And the administration we just got out of it looks like decisions were not made in the most rational, objective way all the time. And so maybe a different president and maybe a lot less cooperative House of Representatives and less cooperative Senate wouldn't have given the Fed and the Treasury all the authority extraordinary authority that they requested, and wouldn't have sat aside and wouldn't have let the Fed do actions which were, I think, widely known by its senior staff to be illegal to save the payment system. Yeah, so I think it could happen again. I think it was very close to happening in 2008. And the question is, and I'd say the only reason they didn't let these banks shut down was that they thought there would be catastrophic consequences they could be catastrophic consequences if they let these banks suspend payments temporarily. And our estimates show there's still some reason to have that belief. Right?
So would it be misrepresenting your argument then to say, this is the sort of too big to fail? You didn't use the phrase, but we've gone from the state level insurance and the Fed's kind of stepped in to underwrite the states in the particular cases that you're looking at. But this is really we're sort of seeing a manifestation of too big to fail.
Oh, for sure. So I think we say there is a small probability that letting one of these very large, say that one of the 5 largest commercial banks in the US, based on the statistical data, there's a small probability that letting one of those banks stop paying depositors for 6. In Rhode Island, the length of suspension is half the people have their deposit trapped for 6 months, and then everyone gets paid back after 3 years. So one of the biggest banks in the US is going to hold an equivalent share of deposits to the state insured institutions that were shut down in Rhode Island. So our estimates would say, yeah, letting one of those banks fail is going to give a shock to household balance sheets, similar to the Rhode Island effect. And so if, we would caution about letting those banks shut down. Now, one thing to remember is that the current policy of the FDIC is, even if those banks failed, they would make all the payments to the depositors. So the FDIC is basically promising liquidity to all insured depositors on the same day, right? The FDIC will seize the institution, will get it back up and running the next business day, and will allow insured depositors access to this. So you can say, well, what about the uninsured depositors? And that is completely a discretionary decision. So yeah, so basically, we would say if you let 2 of the largest banks shut down and didn't pay their uninsured depositors, that would be a suspension of payments the magnitude of Rhode Island. So if you made the uninsured depositors wait to get their cash back until the institution is resolved, that would be a shock of the magnitude of Rhode Island's, and that could have a big macroeconomic impact. And that's discretion, right? The uninsured depositors in the US don't have to be paid on day 1 in full. right? By law, you can make them wait for resolution for repayment. So, yeah, so I think it's definitely feasible. And it's definitely related to this too big to fail argument, and the distortions that too big to fail is. And we can say there's a reason that these banks have so much power over the government and are extracting these big rents, right? Because disrupting their deposits, payment of their deposits could have an effect on everybody.
Thank you very much for that, Gary. I don't know if there are any more questions from the floor, because you've basically answered mine. Manuel?
No, I'm fine.
Okay. Then it's a little less than early than usual, but there are no more questions, then I think we'll start wrapping up. Thank you very much, Gary and his co-authors for coming to the session of the Financial History Network. We have one more session of webinars for this time around, which is Abe de Jong and Just Junkers in 2 weeks' time, roughly. Yep. And
it's
sorry?
First we have the keynote lecture by Carlos Marichal. Then yes, and then we have the Dutch colleagues session.
Thank you very much for setting me right, Manuel. And again, thank you very much, Gary. A big round of applause from everybody. And if I can find it, and we will just wrap up. And hopefully, this has been somewhat useful. Some of the comments that were coming from the or and if any other comes out, we'll ship it your way.
Okay, cool. Thank you very much, everybody.
Thank you very much again for you, Gary.
Thank
you, Gary.
Wherever you are.
Okay, bye.